Greetings everyone. Today my group, the Paladins, which consists of 5 members, and they are Nurul, me, Dennis, Mavi, Muhammad Faisal, and Norzilah. Today my group will be presenting National Income Accounting. National Income Accounting is a framework used to measure the economic activity of a certain country. It includes various methods, mainly 3, to calculate and represent the economic performance of a nation. Definition of national accounting can be defined as national income also refers to the flow of goods and services by a nation over a period of time, usually in a year. Or national income can be defined as the total payment received by the factors of production in a country during a certain year.
Hello everyone, my name is Muhammad Faisal. So I would like to continue with the key importance of national income accounting. So there are 3 importance of national income accounting. First one is understanding economic performance. Second is comparing economics. Third is long-term planning. So understanding economic performance, it's like national income accounting helps in assessing the overall economic performance of a country by providing detailed data on GDP, GNP, and other national income metrics. So this allows economics and policy makers to understand the health of the economy. Second is comparing economics. So national income accounting allows for comparisons of economic performance between different countries. So metrics like GDP per capita enable comparisons of living standards and economic development. So the third one will be long-term planning. So national income accounting is essential for long-term economic planning. Governments use the historical data and trends to forecast future economic conditions and to plan for sustainable development. Thank you.
Expenditure approach. The expenditure approach measures GDP as the sum of the consumption expenditure, investment, government expenditure, and goods and services, and net export. And the formula is GDP equals C plus 1 plus G plus X minus M. Personal consumption expenditure. C equal to household spending on consumer goods. It is include durable goods, non-durable goods, and the last one is services. Gross private domestic investment expenditure. I equal to investment spent by the private sector. It is include non-residential investment, residential investment, and the last one is change in business inventories. Net domestic investment is a measure on how much stock of capital change during a period. Positive or negative net domestic investment refers to the amount of the capital produced exceeds or less than the amount that bore out. Net domestic investment have two formula. The first one is gross domestic investment minus depreciation, and second formula is capital at the end of the period minus capital at the beginning of the period. Government spending, G equal to its consumption and gross investment. It is include federal, state, and the last one local government, and it is exclude government transfer payment. Net export, X minus M equal the sum of spending the rest of the world domestic produced good export or X minus the sum of spending by domestic economic group on foreign produced good imports or M. The reason for including the net export in the calculation of GDP is because of personal consumption. Gross domestic investment and government spending include expenditure on goods produced both domestically and foreign country. Therefore, it needs to minus expenditure on goods produced in foreign countries to prevent overestimating the domestic product. Some of the domestically produced goods sold abroad exported. Thus, the value of those exports should be added into the calculation of GDP to prevent underestimating the domestic production or GDP. Market price is the actual price paid by the consumers, while factor cost is the real price that is earned by the producer or seller. The formula for this method is GDP factor cost equal to GDP market price minus indirect taxes plus subsidies, or GDP factor cost equal GDP market price minus indirect taxes plus subsidies. GNP at factor cost versus GNP at the market price. GNP at market price is national output is calculated using the price in the market. GNP at factor cost is national output is calculated using price paid by manufacturers to owners of the factor of production. So this is the formula. GNP market price equal GNP factor cost plus indirect taxes minus subsidy, or GNP factor cost equal GNP market price minus indirect taxes plus subsidies. After that, difference between the two costs, that is indirect taxes and subsidies. Net national product (NNP) is GNP minus the value of capital consumption or depreciation during the year. And NNP also referred as national income at market price. National income is at factor cost is the total of all income payments made to factor of production. So the formula is national income equal GNP factor cost minus depreciation value, or national income equal NNP market price plus subsidies minus indirect taxes. GNP versus NNP. GNP is the total market value of all goods and services produced by a country's citizen in a year, which is calculated at market or current price. Price of goods sold include depreciation of capital goods. Depreciation will be deducted from gross national product to get the net national product.
Alright, so I'll continue with income approach. So for income approach, it can be concluded that GDP is the summation of total income, which includes wages, rents, interest, and profits received by all the production factors in producing final goods or services during a given period. So the formula to calculate the income approach will be GDP equals to national income plus depreciation plus indirect taxes minus subsidies plus net factor payment to the rest of the world plus others. So next, to calculate the national income. So national income is the total income earned by a factor of production owned of a country's citizens. So this component is the sum of 5 items. So the 5 item of the component is first the compensation of employees, second is proprietor's income, third will be corporation profit, fourth will be net interest, and the fifth will be rental income. So this 5 is the component that we will add on to get the national income. Will be an overview of the formula to calculate the GDP using the income approach. So as you can see here, GDP equals to national income, which is the 5 components, minus the income earned from rest of the world plus income earned by the rest of the world plus indirect taxes plus capital consumption, which is the consumption or the allowance, and also plus statistical depreciation. So this image shows the component and the steps in how we calculate the GDP using the income approach. So to calculate the GDP, we have to plus the national income, including the 5 components, minus the income earned from rest of the world, plus with income earned by the rest of the world, plus indirect tax, plus capital consumption, and plus statistical depreciation. So in this, you can see that in national income, there's 5 the component, which is the compensation of employees, proprietors income, corporate profit, rental income, and also the net interest. So this is the formula, how we calculate the GDP using the income approach. So next, continuing is the sum of all factors income is net domestic income at the factor cost. So there's 2 adjustments that we need to make to get the GDP. So the first adjustment is the indirect taxes less subsidies are added to get from factor cost to market price. So the second adjustment will be depreciation is added to get from net domestic income to gross domestic income. So continuing to there, so next is NDP. NDP is the net domestic product. So this NDP is the measures of the total value of a new good available in an economy in a given year after worn-out capital goods have been replaced. So to calculate this NDP, the formula will be NDP minus the capital consumption loss or depreciation.
And hi everyone, my name is Norzilah binti Muhammad. Next, we're gonna talk about the value added approach. Okay, value added approach is to calculate GDP by measuring the output of each sector in a country. The main advantage of the approach is enables the comparison of the performance among the sector. GDP equal to sum of the value added created by the various sector in an economy or the value of final goods. Okay, this is a formula to calculate value added. So the formula is value of output will minus with value of intermediate good. So here value of output is the revenue from selling the product. Meanwhile, value of intermediate good is the cost of the goods and service used in the production process. Okay, next I'm gonna tell you how to calculate value added step by step. So firstly, we need to identify the value of output. So here we need to determine the total sales revenue from the final goods and service produced by the firm or sector. Number 2, we need to identify the cost of intermediate goods. Here we need to calculate the total cost of all intermediate goods and service used in a production. Intermediate goods are those that are used as input to produce final goods and service and are not counted in the final product value to avoid a double counting. So lastly, we need to subtract the cost of intermediate good from the value of output. Here we can get the value added for the product. Okay, lastly, as you can see, this is an example how to calculate a value added. So this is an example, a company that produce a wooden chairs. So the value of output for the company is 5,000 and the cost of intermediate goods is 2,000. So we need to calculate a value added. So value of output will minus with the cost of intermediate goods. So we can get 3,000 that represent to the value added for the chairs. So that's all from us and thank you for watching our video.